Why do you think hedging a portfolio is important? And do you think a hedge should always be in place and the percentage of the hedge is what should be changed?
Yeah, so I don't think you should always have a hedge. I mean, it obviously depends on the goal of the portfolio, but general rule of thumb, I don't think there should always be a hedge in place. But I think it's very, very important to understand how to do that or to at least diversify the risk away from being 100% long. Because the reality is every single asset class in history, whether it's stocks, bonds, commodities, real estate, crypto, whatever it is, they've all had a 50% plus drawdown at some point in their history and probably will do again in the future. So if you're only focused on one asset class, and you're 100% long that asset class, at some point you're going to have a big drawdown. Now, that's okay if you're somebody that can stomach those big drawdowns because you're looking at absolute return for the long term. Let's just look at stocks as an easy example. We all know it's been the best performing asset class in over the history and probably will be for the next 100 years as well. But along the way, there's also been 40% drawdowns, 50% market crashes, all sorts of things that have gone on, right? Now, that might not be comfortable to sit through for most people, right? And understandably, there's nothing wrong with that. So if you're not one of those people that can do that, well, now you need to know how to eradicate that risk because the reality is nobody knows when that's going to come because otherwise it would never happen because everyone would have the same view and it would just kind of get priced out of the market. So
Correct.
we don't know when for sure when those sorts of things are going to happen. And so therefore you've always got to look at risk adjusted returns that suit your profile as an investor. So again, if we use, the example of somebody that's a bit younger, just very growth, absolute return orientated, they're probably going to be 100% long stocks a good 90 odd percent of the time. And only if we really start to see a big downturn from an economic standpoint and markets and things like that, only then may they actually add a hedge to the portfolio. But you've got somebody that's maybe either just a lower risk individual or, they're a little bit older, different investment goals, don't want to have the big drawdowns, can't afford to at their age or what have you. Well, then you need to understand how to actually eradicate that risk before it maybe presents itself. So then, that's when we look at hedges. So, i.e., to keep it really simple for people that are watching this, if you're long individual stocks, well, something you can do to remove that long risk, because if the market falls, it's probably going to drag everything with it most of the time, right? So what you can actually now do is short the market and say, right, well, if I'm right and my stocks keep going up, I make money over here on these longs. I just lose a little bit on this bit of the portfolio, but I make money overall. But the idea is that if the market does turn down and it drags your stocks with it, although you lose money here, those losses are kind of mediated a little bit by the fact that you're making money on the short position on the actual index itself, so you reduce your losses. So the idea is that you kind of that range of return kind of really narrows down and you get a much smoother equity curve. Of course, there's other ways you can do it. You can diversify into different asset classes because they're not all correlated and stuff, and we kind of touch on that. But the idea really and truly behind hedging and diversification is it's a way of you being able to manage the risk for a tolerance that you're suitable for as an investor, basically.